Hello traders, welcome to your economic calendar update for Monday the 9th of March. I trust everyone had a really good weekend and ready for another week. It's traditional that every single week after the non-farm payrolls, which would be the second week of every month, the economic data is quite subdued. We don't have any major key announcements or key data that the market is really hanging on getting to basically move for the next few trading sessions. So we could see a quiet market in terms of the trends continuing that are currently in place because there isn't any data to spike anything in the opposite direction to create a major fundamental shift. And we could also see the consolidation of some pairs if we don't have any data to move it. However, on Friday, we did have a very large non-farm payroll report of 295, so nearly 300k of additional jobs, which is well above the expectations. People are even talking, including myself, that 240 was probably a stretch and 220 was likely, and we're due to have a flattening out effect of the non-farm payrolls because they can't keep growing at 300,000. But it seems that they can, but we did have average hourly earnings slightly down, but the unemployment rate dropped, so we had a double whammy where we had more people got jobs and the unemployment rate dropped again, which is huge. And we didn't have big misses here on the trade balance especially. So overall, the market was surprised and it's definitely reflected across all the pairs. I'm sure you've all seen it. And we are breaking out of a lot of the consolidations and the range trading. So it means that we are back into trending markets, the easiest market to make money. So take advantage of it, add positions, move your stop losses down, lock in some profits and keep compounding those returns as we see the market move. Now what the move's coming from is what's happened is the non-farm payrolls has created the market to realise quite abruptly that the fundamental divergences between economies is getting wider and wider. So America is going to be forced to raise interest rates whether they like it or not due to their economy going so well. And the market is starting to appreciate that now, that they won't be able to keep it on hold forever and not raise, although we still haven't got a pressing inflation figure. So it could get carried away, the market, a little bit early right now and start to price in an interest rate rise, but we may get a maybe drawn out process because we still don't have inflation pushing to critical levels where the government needs to do something to try and suppress that. But nonetheless, right now, it's the US dollar strength against the rest of the world, where Australia is looking to cut rates and other economies, Europe, as we know, is in the toilet. And the UK economy is going quite well. So it would be the pair that I think would fall the least, but we will be looking for data to confirm whether the UK are going to look to raise rates this year or not, and if so, that will curb the falls in the pound. But let's have a look at what happened on the weekend. We had some data coming out from China here, which is very unbelievable in my eyes. We had a 43% increase in exports all of a sudden, when the trend has been quite low, and even the consensus was that we're going to have a good one, but it's just shot the lights out and quite unbelievable. Also, the trade balance has gone from quite expected to be quite low to quite astronomically large. Now, China has a history of being quite erratic with their data, which also puts a lot of doubt into people's minds of the authenticity of that data. So the market didn't latch onto that, and all of a sudden the Australian dollar, it got a boost a little bit over the weekend if you have a look at the candle patterns over the weekend on the back of this, but it was very short-lived, and people are sort of shrugging it off as a one-off event or possibly some bogus data or a little bit of playing going on there. We also got to note that daylight savings time has changed in the US, so your calendar will change. So be careful of that, update your clocks and make sure that you keep on top of that. We also had a decline in job advertisements in Australia. That's not surprising at all. The employment situation in Australia is not real healthy at all. And the Eurogroup meeting's back in session in a couple of hours' time. I don't expect anything massive to come from this. The only things that are going to move the market are members of the meeting coming out to the press and stating their views, their personal beliefs and things like that. I don't see it as something that's a policy or a structural shift is going to change in the fundamentals at all, and therefore we don't expect to see a surprising bounce in the euro because they've come up with some special plan and it's all been approved. So don't get too worried about that. We do have some UK trade balances coming out of Germany. It's expected to be flat. We have a speech coming out from Mester, but that won't be, and Fisher, they won't be too important. Those guys, their roles on the Fed's board is coming to an end later this year, so their involvement and their opinions are starting to become less significant. And that's it for the day. So a very quiet session. Trends will continue. We could possibly see some consolidation, as I mentioned. Don't give back any of the profits that you've made from the non-farm payroll decision, and be quite patient at re-entering the market. Don't get too overzealous of just jumping in and trying to catch a falling sword, because you could put yourself through a little bit of pain before you see any gain, which isn't really worth it at all. So it's going to be a week where you're going to have to be quite patient. We probably won't be picking up the pips that you thought you were going to pick up or that you picked up in previous week, but nonetheless, make sure it's a profitable one and be quite disciplined. If we have a quick look just before I go, the data that we've got coming out, as I said, it's traditionally quiet. The New Zealand interest rate decision is going to be the first major thing off the block, and it's going to be very interesting to hear what they have to say. That could actually widen the gap between Australia and New Zealand in terms of the Australians left rates on hold, sure, but they indicated that further cuts will be made, and we could see a further divergence between the New Zealand economy outperforming the Australian economy, and that trading pair could actually continue to fall if the RBNZ came out and say that we are still keeping things on hold because we're quite happy with that. And their policy statement is where all the information will be coming from, and it's quite interesting to see if they actually mention this new policy to try and target housing investment to try and curb their housing bubble, because that's the only reason why they would need to raise rates, would be to curb the housing bubble, similar to Australia. But they don't want to do that because they want to keep the stimulus there for other aspects of the economy, which is quite smart. Then we have the employment change in Australia. Once again, that will either hurt the Australian economy and Australian dollar further. In my eyes, we'll have to wait and see. I don't expect it to come out and kill it, that's for sure. There hasn't been any data to indicate such. And then we have some retail sales out of the US. And then Friday we have, once again, some Canadian data. And that's about it. So a little bit of data that should potentially just add fuel to the fire of trends and things like that. If we get a slight surprise, I think that it will create short-term bounces and pullbacks and opportunities for you to sell into rallies against the US dollar and things like that. So keep poised, and I'll be back again tomorrow. So until then, trade well.